You're watching Gold Rush Reporter, where we break down gold and silver with facts, not fairy tales, and where hype gets exposed. I'm your gold and silver analyst, and today we need to clear up one of the biggest lies ever told in the silver market. Let me hit you with the hook right away. Every time silver starts moving higher, every time it gets close to historic levels, somebody pops up and says, "Oh yeah, remember $50 silver? That was when the Hunt brothers cornered the market." That statement sounds confident. It sounds educated. And it's completely wrong. And here's the problem. This myth isn't just repeated by random people on social media. It's repeated by analysts at major institutions, including Goldman Sachs. That should worry you, because when professionals repeat bad history, it tells you they either didn't do the work or they're pushing a narrative. Let me be very clear and brutally honest. If you still believe the Hunt brothers cornered the silver market, you don't understand what actually happened in 1980. Now, let's slow this down and look at the facts. There's a popular chart that circulates everywhere. It shows silver spiking in 1980, labeled as Hunt brothers corner the silver market, and then later, the global financial crisis. This chart is often cited as proof. But here's the first red flag. That chart was produced by a Goldman Sachs precious metals analyst, and it's labeled incorrectly. That analyst did not study the Hunt brothers. She did not study the court records. She did not study the rule changes. She did not study the actual drivers of demand. I did. And no, I'm not saying this to flex. I'm saying it because this topic has been seriously misrepresented for decades. I'm dyslexic. I didn't casually skim a blog post. I had researchers go through a stack of books nearly a foot high. They pointed me to the most important sections. One of the best sources is a book called Manipulation on Trial, Court Transcripts, Hard Evidence. And here's what that research shows. There was never definitive proof that the Hunt brothers manipulated or cornered the silver market. Let that sink in. Even Jeff Christian of CPM Group, someone who is not friendly to silver bulls, admitted in an interview that the Hunts may have added 50 to 75 cents to the silver price. That's it. So what drove silver from under $10 to nearly $50? The public did. Investors lost confidence in the dollar. They shifted from gold to silver because silver was affordable. Silver demand exploded globally. That's not manipulation. That's a preference shift. Now here's where things get uncomfortable. And this is where most analysts stop thinking. While silver was rising, a series of rule changes suddenly appeared. Margin requirements were raised. Position limits were changed. And then came the nuclear option. Liquidation only. That means people could sell silver, but no one could buy it. Let me be blunt. That is not a free market rule. That is a rule designed to force prices down. And here's the real question nobody likes to ask. Why was Paul Volcker, the chairman of the Federal Reserve, involved in these decisions? That's not normal. And this leads to a theory. Not a claim, not a certainty, but a theory that deserves serious attention. The Hunt brothers may not have been the villains. They may have been the scapegoats. Now let's push this further, because if you stop at the Hunt brothers didn't corner silver, you still miss the real story. The real issue wasn't silver. The real issue was gold. By late 1979 and early 1980, gold was in a runaway move. Inflation was out of control. Confidence in fiat money was collapsing. Remember this. The US dollar had only been a pure fiat currency for about 8.5 years at that point. That's nothing in monetary history. Every fiat currency before it had failed. Every single one. Nelson Bunker Hunt understood that. He genuinely believed the dollar was doomed. And frankly, that belief wasn't crazy. It was logical, based on history. Now here's where analysts today completely lose the plot. They talk about cornering, as if the hunt secretly controlled all silver supply. That never happened. What they actually did was take delivery of physical silver instead of rolling paper contracts. That's not illegal. That's not manipulation. That's called not trusting paper promises. Bunker Hunt literally flew silver out of the United States. 3 Boeing 727s, loaded with physical metal, guarded by his own security, flown to Switzerland, locked in underground vaults. Why does that matter? Because it tells you this wasn't about trading profits. This was about capital preservation. Now, let's talk market structure. Something almost no mainstream analyst explains honestly. The gold market is massive compared to silver. Even back then, gold dwarfed silver in size. A market that large is harder to control, harder to influence, and harder to intervene in without causing panic. Silver, on the other hand, is small, thin, much easier to attack. And here's the critical point. Many silver traders were also gold traders. So if authorities wanted to send a message, not just to silver, but to gold, where would they intervene? Silver. Because if you break confidence in silver, gold traders notice. Fear spreads. Liquidation follows. This wasn't theoretical. The silver pit and the gold pit were literally next to each other on the trading floor. These weren't algorithms. These were humans screaming at each other in open outcry. If silver traders saw forced liquidation, rule changes, and collapsing prices, what do you think gold traders did? They sold. That's not conspiracy thinking. That's human behavior. And what's fascinating, and rarely mentioned, is this. Gold and silver peaked on the same day. That's not random. Now ask yourself a hard question. If the hunts cornered silver, why did gold collapse at the same time? There was no concentrated position in gold, like there was in silver. No equivalent villain in gold. Yet gold rolled over immediately. That tells you the trigger wasn't manipulation by private investors. The trigger was intervention-driven fear. This is where the scapegoat theory comes in. By targeting the hunts, regulators could justify extreme actions. Margin hikes, position limits, liquidation-only rules, all framed as protecting the market. But in reality, those rules sent one message loud and clear. If precious metals threaten the dollar, they will be crushed. And people today have no idea how close confidence came to breaking completely. In January 1980, lines were forming to buy gold and silver across North America and Western Europe. The only places where ownership was legal and markets existed. That was only about 10% of the world's population at the time. Today, it's effectively 100%. Let's continue peeling this back, because here's where most people completely miss the lesson. If you walk away from 1980 thinking it's just about the Hunt brothers, you've missed the market dynamics that still matter today. First, think about scale. Back then, roughly 10% of the global population had access to these markets. Today, consider population growth and access. We're talking 18 times more people, globally connected, with access to information and trading platforms. That changes everything. The potential demand for silver and gold is exponentially larger than it was in 1980. Yet the myths about the past continue to dominate analyst commentary. That's a problem, because these myths influence investor behavior, often leading to poor decisions. Second, let's talk about the analysts themselves. Most of the so-called experts at big institutions are clueless about the mechanics of the past market events they reference. They repeat headlines without digging into the facts. That's why you see charts labeling the Hunt brothers as market manipulators, when in reality, the evidence shows something entirely different. They were used as scapegoats to stabilize the dollar and contain gold's runaway rally. Think about that. The US dollar was under pressure. Inflation was raging. Gold was threatening to spiral out of control. The authorities didn't need a silver manipulation scandal. They needed a narrative to justify extreme measures. Enter the hunts. By focusing on them, they could enforce rules that suppressed silver prices, but also indirectly signaled to gold traders. If silver can be controlled, your positions are not safe either. That's a massive psychological lever. Now, let's examine the mechanics. The rules imposed, raising margin requirements, position limits, and liquidation-only orders, were not standard market practice. They were designed to force a sell-off. When you see rules like, you can sell, but you can't buy, that is not a market responding naturally. That is an intervention aimed at a predetermined outcome, price suppression. And remember, the silver market is much smaller than gold. That's why silver was chosen as the symbolic target. Manipulating or controlling gold directly would have been far more difficult. Gold's market was hundreds of times larger. But silver? Small, thin, and visible. It made the perfect example to send a warning without risking gold outright. Here's where the modern analogy comes in. Today, we're facing complex markets with ETFs, derivatives, algorithmic trading, and global liquidity waves. Yet analysts continue to recycle the Hunt brothers story as if it's an absolute rule of the market. They say $50 silver, cornered by the Hunts, without context. That lack of perspective is dangerous because it distorts the lessons from history. The truth is far more subtle and actionable. Market psychology, government intervention, and liquidity constraints shaped that move far more than the actions of two wealthy individuals. Finally, the personal risk lesson here is critical. In 1980, the global community was on the edge of losing confidence in the dollar. Lines were forming at exchanges. Panic was real. Today, the stakes are different, but the principles are the same. Whenever a currency or commodity faces concentrated demand, the response from regulators or institutions can dramatically affect prices. Understanding that mechanism, not repeating myths about cornering the market, is what gives you an edge. Now let's talk about the Hunt brothers themselves, because this is where people get emotional instead of analytical. Nelson Bunker Hunt and his brother weren't cartoon villains rubbing their hands together, trying to own the world's silver. That image is lazy, and it's pushed by people who never bothered to study what they actually did. Their core belief was simple. The dollar would fail. And again, that belief wasn't extreme, it was historically rational. The dollar had only recently been untethered from gold. Inflation was exploding. Trust in government policy was collapsing. So they moved capital into hard assets. That's not manipulation. That's risk management. Now here's the key point most people ignore. Owning a lot of something does not automatically mean you control the market. The Hunts did not control mines. They did not control refining. They did not control global inventories. They did not control industrial demand. They did not control paper markets, margin rules, or exchange policy. What they controlled was their own capital. And even their physical silver position, while large, was not enough to dominate global supply. The silver market was small compared to gold, yes, but it was still global, still fragmented, and still influenced by millions of participants. Now let's address the deliveries, because people love to dramatize this part. Yes, Bunker Hunt took physical delivery. Yes, he flew silver to Switzerland. Yes, it was guarded and stored in underground vaults. That sounds dramatic. But again, that's not illegal. In fact, it exposed something very uncomfortable for the system. When large players demand physical metal instead of paper promises, the system gets stressed. That's the real issue. The futures market depends on most participants not taking delivery. It's built on rolling contracts, settling in cash, and maintaining confidence. When someone says, "No, I want the metal," it reveals how thin the physical layer really is. That's why this story matters today. Now, let's be brutally honest about what actually broke the hunts. It wasn't the market. It wasn't bad timing. It wasn't greed. It was rule changes. When margin requirements are raised suddenly, leveraged players are forced to liquidate, even if their long-term thesis is correct. When position limits are imposed retroactively, it traps traders. And when liquidation-only orders are enforced, it guarantees collapse. At that point, the outcome is predetermined. This is why calling this episode "Market Manipulation by the Hunts" is intellectually dishonest. The manipulation, if we're using that word honestly, came from changing the rules mid-game. Now let's connect this to the psychology of the pits. Gold traders watch silver get destroyed by rule changes. They didn't need a memo. They didn't need an announcement. They understood instantly. If this can happen in silver, it can happen in gold. So they sold. That's why gold rolled over the same day. This wasn't coincidence. It was contagion. And this is the lesson modern investors must understand. Markets don't move only on fundamentals. They move on fear, signals, and precedent. If authorities want to cool a runaway asset, they don't always attack it directly. Sometimes they destroy confidence in a related market to send a message. Now that we've dismantled the myth of the Hunt brothers cornering silver, it's time to connect these lessons to today's market and why repeating these old stories can actively mislead investors. First, let's address why analysts at big firms keep pushing this narrative. It's convenient. It paints a simple villain. Greedy rich guys caused a price spike. Easy story, easy to sell. It avoids nuance. It ignores systemic factors, global demand shifts, and most importantly, the influence of regulatory intervention. But here's the reality. When you study history like I have, what you see is that the market's moves were driven by a combination of structural vulnerabilities and human psychology, not manipulation by one or two wealthy players. And that's exactly what traders today need to understand. Let's break it down in clear terms. Silver is still a thin, highly leveraged market compared to gold. That means it's sensitive to small changes in demand, speculation, or regulatory signals. Unlike gold, silver doesn't have the same institutional depth to absorb shocks. That makes it a prime target for price swings, whether by natural market forces or by external interventions. Second, remember how panic spread in 1980. It wasn't just the Hunt brothers' holdings that triggered selling, it was the rule changes. Liquidation-only orders, margin hikes, and position limits forced sales. Fear rippled across both silver and gold pits. Today, that same principle applies. If markets perceive that authorities or institutions might intervene, even indirectly, traders react preemptively. Fear is contagious, liquidity dries up, and prices can move violently. Third, we have to talk about public participation. Back in 1980, only about 10% of the population had access to these markets. Today, the situation is dramatically different. Global populations are connected, trading platforms are accessible, and information travels instantly. That amplifies volatility. A narrative, even a false one, can cause massive market moves if enough participants react emotionally rather than rationally. Now here's the hard truth that most analysts avoid. Repeating myths about the Hunts doesn't just misinform, it obscures real risks. Investors who base decisions on cornering myths are ignoring liquidity risk, intervention risk, and the psychological factors that actually drive price spikes and crashes. This is why you see markets overreact to news, rumors, and even casual comments from major firms. Let's bring this back to a practical takeaway. The lesson for today isn't about hating on billionaires. It's about understanding market mechanics, leverage, and regulatory signals. If silver or gold starts moving aggressively, don't ask, who's cornering it? Ask, are margin requirements changing? Are liquidity waves forming? Is there intervention risk or unusual regulatory action? What's the public sentiment and herd behavior doing in response? That's what separates serious investors from the noise. That's what separates analysts who understand the system from those who just recycle myths. Finally, let's touch on timing and opportunity. History shows that markets don't reward ignorance. Those who focus on headlines and old narratives miss the actual dynamics. The Hunt brothers were a scapegoat, not a manipulator. Today, if you understand leverage, liquidity, and intervention mechanics, you can anticipate opportunities and risks before the crowd reacts emotionally. Here's where we tie everything together: the real lessons from 1980 and why they matter to anyone trading or investing in silver and gold today. First, let's be crystal clear. The Hunt brothers did not corner the silver market. That's a myth. What happened in 1980 was a combination of public demand shifts, thin market structure, and regulatory intervention, all amplified by human psychology. Understanding this distinction isn't just academic. It's critical if you want to navigate precious metals markets intelligently. Think about it. Silver and gold markets are not independent. Movements in one often ripple into the other. Back in 1980, the silver pit and the gold pit were physically next to each other. Today, while electronic trading dominates, the principle is the same. Markets are interconnected. If one market is forced to liquidate, whether by rules, panic, or leverage positions, the other reacts almost immediately. That's a lesson too few traders internalize. Second, intervention risk is real and persistent. The liquidation-only orders imposed on silver in 1980 weren't just procedural. They were designed to cap prices and signal to gold traders. Today, central banks, regulators, and even large institutions still have the power to influence market behavior indirectly. Understanding who has influence, how it can manifest, and when it might occur is far more valuable than worrying about cornering myths or conspiracy theories. Third, the scale of public participation has changed everything. In 1980, about 10% of the population had access to precious metals markets. Today, nearly everyone can trade online, access information instantly, and act on global news in real time. That means volatility can be explosive, and narratives, even inaccurate ones, can move markets quickly. Recognizing that dynamic is the key to staying ahead. Now let's focus on the practical takeaway for investors and traders. Ignore recycled myths. Stories about $50 silver and the Hunts cornering the market are entertaining, but they are not actionable. They obscure the real drivers: liquidity, intervention, and psychology. Study market mechanics, margin requirements, leverage, position limits, and the relationship between gold and silver are far more predictive than stories about past individuals. Anticipate reactions. If you understand how humans react to stress, fear, and signals, you can anticipate price swings before they happen. The Hunts taught us that fear can be engineered and confidence can collapse quickly. Focus on opportunities, not villains. Back then, the Hunts' actions highlighted vulnerabilities in the system. Today, the same principles apply. Small markets, leverage positions, and sudden interventions create opportunities, if you know where to look. Finally, let's close on a broader lesson. History isn't just a story. It's a blueprint for understanding risk, intervention, and behavior in precious metals markets. The gold and silver you trade today are influenced by similar dynamics: liquidity shocks, regulatory action, and herd psychology, even if the players are different. By learning from the real mechanics behind 1980, you're better equipped to make informed decisions instead of chasing myths. This is what separates a serious analyst or investor from someone lost in recycled headlines. I'll leave you with this final point. Don't just follow the crowd or repeat what analysts at major institutions tell you. Look at the market, understand its mechanics, study history accurately, and you'll see opportunities others miss. That's the real edge. Thanks for watching Gold Rush Reporter. Keep learning, keep questioning, and stay prepared, because understanding silver and gold is about seeing through myths to the real forces at work.